Allison Hirsch, representing Controller Bradley.
John Dorso, alternate designee for Controller Bradley.
Steve Meyer, invited participant.
Brian Berge, representing Mayor Eric Adams.
Phil Dukes for Finance Commissioner Nyblack.
Arthur Regner from the PBA.
Chris McGrath, PBA by invitation.
Nicole Jambrisi, Police Pension Fund, present by invitation of the fund.
Anthony Bradley, SBA.
Jeffrey Ward, DEA.
Stanley Thomas, Police Pension Fund by invitation.
Andy Bishop Miller, Police Pension Fund, present by invitation.
Kevin Holleran, Police Pension Fund, present by invitation.
Michelle Davidson with Axia, present by invitation.
Leon Dublin, Controller's Office, present by invitation.
Ashley Lee from Axia, present by invitation.
Okay, John? All
Kevin,
right.
Kevin, it's Chris Monahan from the CEA. Kevin, you got me?
Yeah, I got you. Thanks, Chris. Sorry about that. And LBA?
All right, Lou Turco, I believe, is running a little late. I'll have his proxy till he arrives.
No,
See
actually,
you.
Chris, he said he's on, so,
Oh,
I
okay.
just got a text from him.
It looks like he fell off.
Yeah,
He might be having connectivity issues.
All right, I know
Yeah,
he
let the
was.
record-
No, he's here, he's
Yeah,
here.
let the record
He's just
reflect
on
that we
mute.
can see that Lou is on.
Kevin, I'm on. Kevin, can you hear me?
Yes, we can hear you. Thank you. Okay, John?
Okay.
Lindsay Merrick also, or no? Actuary?
Oh, yeah, actually.
Merrick is on.
Okay, so we'd like to note for the record that the actuary as well as several members of the BAM team are on via Zoom. And in the event that any of them speak during the meeting, we'll ask that they identify themselves for the record. And I also want to note that Wilshire, our general consultant, is also on via Zoom, and we'll ask that they identify themselves when they speak, which I'm sure they will on the record today. So with that, we have a very short public agenda. We'd like to start by saying Happy New Year to everyone on this board and everybody watching via Zoom. And we look forward to having a productive year at this board. In order, though, to move forward, we need to know what happened in the past. So I'm going to turn it over to Steve Meyer, the Chief Investment Officer, to give us a very quick, past view, I guess, of what we saw.
Great, John, thank you. And I've been told in advance to give a Reader's Digest version, so I'll be brief. Wilfredo, or Kate, you go one slide ahead. Just real quick, I mean, obviously, U.S. and global inflation has decreased around the world, and deflation,
Andy, is it possible to minimize the screen?
Thanks.
This one? Yeah, thank you.
And disinflation is actually taking hold across the economies worldwide. Inflation's down, and the Fed rhetoric has actually shifted, causing markets to really price in rate cuts in 2024. The summary of economic projections for the Fed came in looking in December as though there's going to be 3 rate cuts in 2024. The market was pricing in as many as 6 in the latter part of last month. I actually take the under on that. I think the Fed's going to be more prudent. My expectation is they'll probably be on hold until at least the second half of the year. And the cuts may not be as many as certainly as expected at this point. I think the good news is the expectation is rate hikes are done, and bond prices have increased significantly and yields have come down significantly. I'll talk a little bit more about that in a moment. And the next slide, just to look at where inflation is, as I mentioned, CPI on an annual basis is down to 3.25%. Actually, for November, it was actually 3.1%, so it continues to move dramatically lower. If you remember, in June of 2022, it was as high as 9.1%. The core PCE price deflator has actually been a little more sticky, around 3.5%, but that continues to move in the right direction in the yellow on the far right-hand side. Inflation around the world on the next slide is similarly come down. Inflation actually in the European Union is just 2.5%, which is, I think, a really good result. Continues to still be a little bit higher in the UK, but again, moving nicely in that direction. The next slide. Employment growth has slowed in line with Fed expectations. The unemployment rate is still below 4%. It came in at 3.7% in November. This Friday, we get another non-farm payroll report and unemployment report. Consensus estimates are anywhere between 135,000 to 170,000 jobs created, with an unemployment rate moving slightly higher from 3.7% to either 3.8, 3.9%. So expectation is for continued slowing in employment growth. Wage prices are still actually pretty robust. They moved up 4% in November year over year, something the Fed continues to watch. And we'll see what this Friday brings us at 8:30 in the morning. On the next slide, a look at again where we are from an unemployment perspective. In white on the bottom, you can see we're 3.7%, fairly stable and quite tame for the better part of 2 years. Again, the expectation was with the Fed's hiking cycle, unemployment would move materially higher, and that hasn't transpired. So I think that's good news for those folks that are still at work or finding positions. The participation rate in yellow, you can see it's still below where we were pre-pandemic, but again, moving up nicely since the extremes that we saw through the pandemic. I'd say the other takeaway from this slide for me is that the pandemic was incredibly disruptive. This is not a normal economic cycle. And a lot of what we talk about in terms of returning to normalcy has a lot to do with, again, coming off the excesses that we saw in 2020, 2021, and into 2022. On the next slide, a quick look at expectations on the far right-hand side, where the forecasts look for employment growth to continue to move lower. And as I said, the Bloomberg estimate today for this Friday was 135,000. Consensus estimate is as much as 170,000. And in November, we saw 199,000 jobs created. So the expectation is for employment growth to continue to slow and for unemployment to slowly move higher. On the next slide, the third quarter U.S. economic growth was fairly robust, coming in around 5%, really about 4.9%. And U.S. growth has outpaced expectations relative to China. On the next slide, you can see actually where China and U.S. economic growth converge. China in green, the U.S. in red at around 4.9%. Obviously, it's pretty healthy for the U.S., less so for China. There are significant challenges in China, which I'll talk about in a moment. On the next slide, the United States, the Bank of England, the ECB, and the Bank of Japan rates have all been on hold recently. The Fed hasn't changed rates in three meetings. Expectations that given, again, global disinflation or a reduction in the rate of inflation, the next rate changes will be cuts pretty much across the board. The one exception is Japan. Japan still has the rates where they were from 2016, almost going on 8 years, and they are still at a negative 10 basis points. On the next slide, just a quick look at that, and you can see on the far right-hand side, the staircase is up. The U.S. Fed, the Bank of England, and the ECB all moving rates higher as we were combating inflation. Again, in purple on the bottom, Japan is the outlier. They've left rates, as I said, almost going on 8 years at a negative 10 basis points. Although they have tightened up some yield curve control, and the longer rates have actually moved higher, but their official short rates are still negative. On the next slide, November, December bond prices increased quite substantially and yields came down. Credit spreads in the U.S. investment grade and high yield corporate debt have tightened on both retail and insurance company inflows. And there's been a huge investor interest in private credit, which I'll talk about in a moment. Let's skip the next slide because it's a little stale and take a look at U.S. Treasury yield history. Lost where we were. One more.
Sorry about that.
That's okay, Kate. I knew you were having trouble keeping up today.
Let's see, where were we?
One more, Kate.
Full interest rate.
No, one more. That's perfect.
We were here.
So,
Okay.
yeah, we're one behind. There we go. Those are 2-year and 10-year yields. You can see on the far right-hand side in white, those are yields that are a little stale. Actually, as of this morning, 2-year treasuries are yielding 4.33%, and 10-year U.S. treasuries are yielding 3.96% this morning. It's interesting to note that they began the year of 2023 in January at a 3.88 yield in 10 years. It actually ended last Friday, the last day of the year, at a 3.88. So despite the fact that it's trading in a range from as low as 3.30% in 10-year treasury yields to as high as 5.01%, they ended up where they started out. So a lot of volatility and a lot of movement, but again, it was a full round trip. On the next slide, Kate, Just a quick look at credit spreads. In yellow, you can see high yield credit spreads have come down a little bit at 363 basis points over comparable treasuries. And in white, you can see that investment grade credit spreads have also come down a little bit at 101 basis points. So a decrease in credit spreads actually serves to increase the price of those holdings, holding duration constant. On the next slide, since early November, stock and bonds have surged in price. For the month of November, the public market 60-40 portfolio, 60% equity, 40% fixed income, delivered a 7.6% return in that single month. It's been referred to as a great year for the month of November. That 60-40 portfolio, again, is an example, over the full year of 2023 delivered a little over 11% return, so quite significant. On the next slide, looking at the third quarter again, ending the end of September of last year now, you can see there's a lot of red on the screen. It was a challenging third quarter for both public equity and public fixed income securities, and bond yields moved much higher in that portion. And you can actually see that the bond yields moving up, the price of those assets down 7%, and that actually is compounded across 1 year, 3 year, and 5 year, delivering negative returns. So just a sense for the magnitude of the sell-off in fixed income. It's a better entry point now, certainly than it was pre-pandemic. The world equity markets, you can see on the next slide. On the far right-hand side, you can see that the changes year to date through the end of December. The Russell 3000 for the full year came in at slightly above 19% returns. European stocks were also higher across the board. There's a little bit of red towards the lower portion in Asia. That is mostly the Chinese market, Hong Kong, and the Chinese, the CSI 300 coming in negative. Again, that economy struggled a little bit, as I touched on earlier, but significant improvement in prices across global equities. On the next slide, a quick look at world bond markets. On the far right-hand side, you can see the yield changes. And as I mentioned, you can see up top that there was only a 4% change. This is as towards the end of December. We wound up exactly where we started, with a 0% change for the full 12 months, 10-year yields. As a general matter, when you look down, you can see the credit that yields came down pretty much across the board, with the exception of the UK and Europe, all negatives, meaning that the rates have come down. In Japan, as I mentioned, the yield curve controls come off a little bit, and you can see the yields there moved 26 basis point higher, again, looking on the far right. Market returns, real quick on the next slide. You can see equities have recovered since the lows of September 2022, and a lot of volatility on the far right-hand side of that screen that looks at annual returns for public fixed income. A very significant decline in pricing in 2022, a rebound in the early part of 2023, and then some volatility in the third quarter. On the next slide, looking at recent news, I touched on earlier the fact that China's been struggling a little bit. The economy has been challenged by a poor property market. They also have concerns about their shadow banking system there. It's anywhere between $7 to $11 trillion of off-balance sheet non-bank debt. And the thinking is at some point the federal government there may have to step in, which is why Moody's actually placed China's sovereign rating on negative credit watch early in December. A couple other things to note in crypto land. Sam Bankman-Fried of FTX infamy is heading to prison, found guilty on all tort charges. And there's been some volatility around OpenAI leadership, with CEO Sam Altman leaving and then coming back, and a changing of the guard at the nonprofit board that oversees OpenAI. On the next slide, just some food for thought. And this is actually a chart that looks at bubbles, a reminder that asset class bubbles in specific sectors and themes do in fact occur over time. And if you can look back to where gold had started out and peaked, a pretty dramatic increase in green on the far left, the run up in Japanese stocks and then sell off. You can see the China spike in terms of China assets. Bitcoin, noteworthy today in red. You can see it came up and it came all the way back down. Bitcoin actually hit a recent high this morning of $45,000 per coin. It's up fully 69% since October. Most of this is largely driven by expectations of an ETF, a Bitcoin ETF coming out. increasing liquidity and driving the price of those coins higher. I'd say the last takeaway from this is on the far right-hand side. You can see that aqua green, I think that is, aqua blue. That's actually an indication of where artificial intelligence-related stocks have gone. So significantly higher. I don't actually think artificial intelligence stocks are at the level that we've seen some of the excesses, say, in the internet boom in 1999, 2000, 2001. But again, a lot of the stocks that are reflected here fall into what's referred to as the Magnificent Seven. Move to the next slide. This is actually an indication of the S&P 500, and really how just the Magnificent Seven stocks delivered up to 80% in aggregate returns for the year. As a reminder, those stocks that are, again, AI related are Apple, Microsoft, NVIDIA, the chip maker, Amazon, Meta or Facebook, Tesla, and Alphabet or Google. So quite a run up, whereas the 7 magnificent stocks were up and the other 493 were basically flat. So that either speaks to a decline in the Magnificent 7 or hopefully a catch up in the other 493 S&P 500 stocks in 2024 and beyond. On the next slide, just a couple more things to think about as we move into the new year. We see that there's been some increase in defaults in speculative grade credits. On the far right-hand side, you can see that they moved up in high yield and loans. Again, perhaps just an indication that things may be souring a little bit in terms of some of the excesses. On the next slide, we look at credit card serious delinquencies beyond 90 days, and you can see similarly on the right-hand side, they've all moved up in 2023. Next page, you'll look at auto loans, same thing, same story where you've seen default rates kind of moving up, serious delinquencies moving up. On the next slide, another signal that the economy may be slowing. So this is actually reflects a rapid decline in bank lending. Remember, we had those disruptions. We had a couple of troubled banks in March, April, May of last year, and a couple of defaults actually, or takeovers. This is actually a look at the U.S. bank lending and how it's come down. It's basically a little below zero, meaning it's contracting instead of expanding, which is going to be a constraint on the economy. This is material in that most of small and medium-sized businesses get their funding from local banks. So as banks pull back, it tends to hurt those constituent companies, the U.S. small and medium-sized firms, that will ultimately have an impact on growth in 2024. On the next slide, some food for thought. And I try to put in context in terms of using one of Dorsey Flock at Apollo's slides. This actually shows the growth of different sectors over the past 10 years. On the far left is a look at the global fixed income market outstanding. It's now a total of 136 trillion, and it had a $42 trillion increase in the last 10 years, which includes the pandemic and a lot of fiscal spending, which reflects a 44% increase in global fixed income outstanding over one decade. Right next to that is the global equity market cap, which in total is about 110 trillion, up about 35 trillion over the last 10 years, or an increase of 46%. I was able to dig a little bit more in my prior presentation a couple weeks ago. I didn't have this stat, but the third over from the left is the global size of the banking sector at fully $98 trillion. It's up $34 trillion, so a significant increase there as well. And lastly, and most importantly, on the far right, you can see that the private capital market, AUM, has increased $8 trillion over the last 10 years. Now, I was incorrect. I actually thought it was a new base of about 40, which would represent a 25% increase. It's actually a new base of closer to 13 trillion, again, according to Apollo, which indicates fully a 160% increase in outstanding of private equity, private debt, infrastructure, and real estate over the last 10 years. Again, 160% increase. On the next slide, again, food for thought. This is actually a slide of Chinese holdings of U.S. Treasuries. And you can see that they're certainly moving in the wrong direction over the last 23 years. They basically peaked back in 2012-ish, and they've been coming off. So the reason this is material is, as the U.S. continues to run huge fiscal deficits, they need to issue a lot more sovereign debt or Treasury securities. The expectation is the average auction size in 2024 will be up by 24%, which means there's a lot more supply coming at a time where China and Japan, for that matter, are buying less and less of our debt. So the question is, who will the marginal buyers be and at what price level? And this indicates to me that there's going to be more of a focus on our fiscal deficits versus our macroeconomic growth going forward. And you may see some continued upward pressure on bond yields associated with this increase in supply coming and this potentially slightly diminished demand. Sorry. On the next slide, just a look at Chinese consumer confidence. You can see it's fallen off pretty significantly in 2022, 2023. It actually had been higher, and then coming out of COVID, I mean, it really fell off and never really recovered to this point that we're expecting. So I know Xi Jinping's got a lot of work to do in terms of restarting that economy. Again, concerns about the property market, concerns about shadow banking there. And again, just a note that Moody's did put sovereign debt in China on credit watch neg. Now moving to just a couple of things that are much more important to your portfolio. One more slide, Kate, please. This is just a new slide that Dan Haas has pulled together. We're trying to provide, just a different look into the portfolio. This is actually Police's total plan. You can see for 3 months. And again, I hate looking at such short-term measures, all in red. I mean, it's been a challenging third quarter of the year ending in September. More importantly, though, if you look out to the right-hand side, 1 year, 3 year, 5 year, 7 year, 10 year returns are what we should be focusing on, and they are still generally all positive. On the next slide, just a different look at how we think about things. So that red line actually represents a 7% actuarially assumed rate of return, compounded over time. And you can see where we've been above that level and below that level, but we are trending higher with that 7%. So we're pretty close to delivering on that 7+% target, which we certainly achieved in fiscal year 2023, and hope to do the same in fiscal year 2024. On the next slide, again, looking at net public market returns by strategy, again, through September, 3 months, really a challenging month. 2 exceptions there were high yield. It's got half the duration of investment grade credit, and credit spreads have tightened, so it delivered a positive return, notwithstanding the fact that bond yields have backed up. And cash is king. That 1.4% return is a 3-month return, so your cash is still yielding around 5.20, 5.30, 5.35 right now. The expectation is if and when the Fed begins to cut rates, those rates will come down as well as T-bill rates will come down. On the next slide, I'll look at public market excess returns in basis points. Here you can see that a little bit of red relative to where the others were, and then the full police policy benchmark, which includes private markets. World equities ex-US struggled a little bit. 2 of the active managers, Bailey Gifford and Walter Scott, actually underperformed their benchmark, which delivered, but did lag that benchmark for the quarter. It's not to say that they're not good managers, and we'll see how that plays out over time. On the next slide, a look at net private manager returns by strategy. And you can see that hedge funds were up. Everything was up with the exception of core real estate. And again, that's a repricing of commercial real estate and retail malls associated with your holdings. They're down 8.2%. On the next slide, we'll look at police private market excess returns. I'd say the thing that jumps out here is the red next to private equity of underperformance of the benchmark of 1,440 basis points. I think it's important to remember that the benchmark isn't a perfect parallel to the private markets. In fact, it's quite imperfect. But recognizing that year over year, June of 2022 through June of 23 marks, private equity delivered a positive return of 4.4%, while the Russell 3000 delivered fully an 18.9% return. So we're under by 1,400 basis points, but again, the expectations will continue to exceed that. And again, focusing more on longer term, you look at 5 years, 10 years, and since inception, with very little exception, with the exception of core real estate, it's all green, and there has been a positive excess return relative to those public market benchmarks. Last slide, for public session, just a look at rebalancing activities. Notwithstanding the fact that U.S. equities were off, they were off less than, fixed income. So we're selling, large and mid-cap equities to raise cash, to meet benefit payments and, private market capital calls in the third quarter of 2023.
So, can I ask a question?
Sure, please.
So Kate, if you could go back several slides, there's the 7% graph that shows the red line going forward. Yeah, so I guess my question, Steve, is this goes back to 2018?
Yes.
Given that we're a long-term investor, is there a way to see this in the future going back 10 years? And to show it as really a long-term projection of where we're at and where we're headed?
Yeah,
Because I think it's going to look very somewhat similar, but I think, 5 years is really, to a plan that's over 100 years old, we're almost 100 years old. I think we are 100 years old.
1857.
Yeah, 1857. 5 years doesn't really register as
Fair point.
as enough time to kind of understand this. And I do think it also articulates why the city smooths out the payments, because you can see the move in the market and the volatility. So I think it was a great slide, but I think that it'd be better if it was at least 10 years. I don't know if it makes sense to go further than that.
I would go as far as we can. I'll work with Dan Haas to check on the data availability.
Yeah.
But that's certainly a very reasonable, and I do think you'll see that trend. That's the trend you want to see. Maybe not with so much volatility, but it really doesn't matter if you're a long-term investor, as long as you're hitting those marks.
Yeah, but I think it'd be interesting. I mean, if we don't want to get hung up on the short term, if we're long-term enough.
Yeah.
Hey, this is Mark. Can I chime in for a second?
Sure.
So is Mark Tiskevich, Chief Actuary. So when I presented to the board, was it over a year ago on the discount rate, it did go back 40 years using the controller's numbers that we tabulate. And so over a 40-year period, it was the arithmetic average was 10.3% for police. Geometric was 9.75.
Great. Thank you, Merrick. That's fantastic. And I remember seeing your slide, so I don't want to imply we've never seen it before. So I do want to thank the actuary.
I haven't.
Yeah.
But yeah, no, that's helpful, Merrick. Thank you.
Sure.
Any other questions? I know I went through it pretty quickly.
So with that, I'm going to make a motion that we exit public session and enter into executive session. Is there a second? Okay. So all those in favor, aye.
Aye.
All right. So, okay, so we are now in public session, Kevin?
Okay. During the executive session, the trustees heard from their consultants, BAM, and several managers regarding infrastructure, real estate, private equity, alternative credit, hedge funds, and one item held over from a previous meeting. Decisions were made. The results will be made public at the appropriate time.
So with that, I'd like to make a motion to adjourn.